Basically, today we just wanted to talk about annuities. A lot of people hear that as a cuss word. Grandpa's annuity, you put your money into this contract, you die, the company keeps all of your money, your family's screwed, and you got a really poor rate of return. You have people like Ken Fisher, Dave Ramsey, who all they say is like, I'd never sell an annuity. I'd rather die and go to hell than to put my worst enemy into an annuity. And it's like, man, you guys know better. You're just building a book of business off of fear. Annuities are really staple in someone's portfolio. I mean, there's a statistic that I read that an annuity, just a regular income annuity, can take like 80% of the stress off of somebody's portfolio, but people are afraid of it because they don't know what it is. So today, you kind of wanted to talk about like some case studies, a couple clients that we've ran through to where the annuity just made so much sense. And this is just a regular case. This isn't just like a we saved somebody from, a burning building type of situation. So David, you pretty much have all the information on that person, so I'll go ahead and hand it over to you.
Yeah, we'll go over the case study, but again, on annuities, the reason there's so much of a bad taste in people's mouths with that, like Dustin said, it's like a 4-letter swear word, to be honest, sometimes, is simply because annuities back in, gosh, 20, 30, 40 years ago, they were literally just like a pension. There was no real options. There's no frills. It was just, hey, you give your money to an insurance company for a period of years and you get an income for the rest of your life. You give up that money and you, like Dustin said, sometimes you lose it. If there's, you pass away before a certain period, you don't get your money. There was all those things back then. And that's kind of where people's knowledge stopped when it comes to annuities. So we'll go over again a recap of some of the different types, how they could help your specific situation. Then we'll go into a case study of a lady that we met with. But the whole point of an annuity, like Dustin said, is to eliminate the stress of retirement. All I mean by that is if the market's up, if the market's down, if you have to take income by selling positions in the market, that can create some uncertainty because you're the one out there clicking the button and saying, hey, do I want to sell? Maybe I don't want to sell because the market's down, or you take too much out because the market's up. You are the one emotionally deciding on your financial life, which is why it's so stressful. And again, we go back to kind of the analogy of driving through a road trip across America. If you fill up at a gas station and know you're never going to run out of gas, going through the desert is no issue. But if you think you're going to run out of gas in the hot desert, of Texas, you're going to be sweating and not enjoying the ride at all, simply because you don't know if you're going to make it to the destination. So you start sweating, not having fun, not enjoying the trip, just because you are uncertain about what the outcome is going to be. So that's, again, the same thing with retirement. Is it's just meant to give you more security. It's not meant to be the full retirement picture, but also equities is not meant to be the full picture either. So you need a balance of both. But what is the balance that you need? That's going to depend on your risk tolerance, how much income you need, and a couple other things. So quickly, one thing that I want to say is typically the most stable retirement that we've seen is where people have 3 sources of retirement income, right? They have some type of pension or fixed income, which is going to be guaranteed for the rest of their life. So that's the first one. The second one is usually some type of personal savings, like a 401k. And then, the third one, we'll just say Social Security in air quotes, because it's not really going to be solvent in the next 10 years. But if you have a guaranteed stream of income, and then you have something that's in the market that's growing, and then another supplement, you can live a very comfortable retirement if you have the 3 stool of retirement. So with annuities, typically what you want to see is you want to make sure that your expenses. So I'll give you an example. This lady, her expenses that she wanted to cover were about $48,000 a year in retirement, where she said, hey, I paid everything off. All I really need is $48,000 to maintain the quality of life and do a little bit of trips with the family. She has a big family. She has like 9 siblings, I think she said. And she wants to be able to go see them, do fun things with them occasionally throughout the year. Nothing elaborate. That is equating to $40,000 or $48,000 a year that she needs. So all that means is after taxes, that's what she needs to bring home. With where she was at, she wanted to make sure she had a guaranteed income no matter what happened, meaning she would rather, instead of having assets in the market that she's taking out and deciding when and how, she said, you know what, I just want to make sure that that expense is covered with some type of income annuity where she doesn't have to click the button. She doesn't have to sell it. She just knows that her expenses and what she wants to do is taken care of, guaranteed no matter what's happening. So that's usually the most stress-free retirement, is when someone has a situation like that. If someone doesn't have a guaranteed income coming into their financial life, one other route that they could do is kind of what we are going to talk about here. So you can cover all of your expenses with a guaranteed income, or you can say, hey, you know what? I don't really want a guaranteed income. I want to have a little bit more risk, a little bit more growth. That's what we're going to talk about here. So this lady, she was 60 years old. She was wanting to retire at 70. Her main retirement goals were wanting to be efficient with what she had and making sure that she didn't run out of money, all the typical things that we hear. And also just that she wasn't an expert in the market. So she didn't want to worry about having to buy and sell and a lot of that. So for her, her income was $10,000 a month. And again, her expenses were $48,000 a year. What we ended up doing based on her situation, from $500,000 of her 401k, we ended up doing two things for her. She wanted to make sure she was protecting a good chunk of what she has right now, simply because of the fact of not knowing where the market's going to be, and losing money with where she was at was going to hurt her more than gaining more money would help at this stage of the game. So for her, we took about half of her 401k, which was $250, and we protected it with an FIA. So again, the reasons you do that is because inside her portfolio right now, she actually had a blend of about 50% equities, about 50% bonds or income, fixed income. When you have a portfolio like that, by again just taking out the fixed income or the bonds, whatever that is, and putting in an annuity of some type, you can increase the income and protection of the portfolio because they're already trying to be safe with part of their portfolio. If you guys all look in your portfolio, I would encourage you to do it. See if you have a target date fund, how much is in equities, how much is in bonds, and look at the percentages, because there's something called the rule of 100. That's a rule of thumb. It's not a hard rule, but if you do 100 minus your age based on the target date fund, it's probably going to tell you if you're 60, you'll have about 40% of your assets in the market in equities. That means about 60% needs to be in what we would call safe money. It means you don't really have a risk of loss. It's more conservative. And that's where bonds and stuff come in. So to wrap all that back up is, why would you consider using an annuity for part of that safe money? We never want to supplement it for equities, because equities can grow, they can do its thing. But for her, she wanted to take 50% out of her fixed income and put it in an FIA. Because if you look at bonds on average, again, I'm not a financial advisor, but if you look at average of bonds over the last 30 years, they're about 4.4%. I think last time I checked, something like that. But you could even ask a client, hey, Mr. and Mrs. Client, do you remember what happened in 2008? Yeah, most people do. It's pretty drastic. What did the market return? It was like negative 40. Well, most people don't realize that the bonds are a market too. So what did the bond market do in 2008? No idea. How would you feel if you were supposed to be getting safe returns and getting about a 4% average, but you had a negative 20% loss with the money you're trying to be safe with? Like, most people kind of just freeze up. And I remember I had a call with a gentleman who was an engineer and a huge number guy. And when I brought that up, he just kind of, it's like, what do you mean? I didn't know that. So again, if we're trying to be safe with money, by implementing an annuity that has no risk of loss when the market does go down, and we get some good market participation on the way up when it does do well, we can increase the return of that side of the portfolio without adding any additional risk. In fact, we're most of the time taking away risk because we don't have the bond interest rate risk. So again, recap, they had 500K in their 401k. Trying to figure out what to do. We protected half of it in an FIA. That what it does is it has a floor of 0%. All that means is if the market goes negative at any given year, whether it's year 1, year 2, year 3, year 10, year 15, all of the interest they've gained plus the principal is protected in there. So that's what we did with half of it. The other half we just let keep growing in the market, because she said, you know what, I still have 10 years till I retire. I think the market over the next 10 years is going to do decent, which I would probably agree with. Over a 10-year period, that's a long enough time. But she did want to protect some of the money that she did have. So that's the first step of what we did. With where she was headed, to give you some context of why we implemented the strategy we did, if she kept saving like she was saving for the next 10 years, she was on track to have about 1.4 million of assets at retirement at age 70 in her 401k, because she was saving about 31,000 a year. She was doing the max based on her age. And if we get to 1.4 million at age 70, obviously 4% rule comes into play. So we can take out safely about 4% of that money for the rest of her life without having to worry about running out of money before she runs out of life.
And that was pre-tax 401k, right?
Pre-tax 401k. So again, that's before taxes. So that was $56,000 roughly a year pre-tax that she was going to be having for the rest of her life without an issue. That after taxes ends up, again, not a CPA, but looking at where her tax brackets fell, and can't predict rates 10 years from now. But with a 15% effective tax rate, which is kind of where she fell, it looked like that was exactly $48,000 a year, which is really tight. So from 1.4 million, we could only generate, again, about $48,000 a year tax-free or after tax, which is not much, right?
Better hope her electric bill doesn't go up.
Yeah. And again, that's not accounting for Social Security in her case. We didn't even go over that because she wasn't very optimistic that it was going to be around. So we just left that off the table.
Yep.
So where she was, again, keep note of this, was $56,000 a year pre-tax, about 48 post-tax. With supplementing with an annuity, what we can do is now we don't have to abide by the 4% rule in retirement, because keep in mind, the 4% rule, you have to hedge against two things, which is market ups and downs, or volatility is what fancy people call it. And you have to hedge against fees in a 401k. And then, taxes is kind of a side quest. But because we have market volatility and fees, we only can take out the 4%. So with an annuity, the annuity has no fee, which a lot of people don't realize. The reason it has no fee is because you pay with your time, just like a CD. So if you go to the bank, they don't charge you 1-2% for a CD. They just say, hey, how long do you want to give us your money? So same thing with annuities. You say, hey, here's my money for 7, 10 years, 14 years. Common misconception that we get all the time is like, oh, I can't access my money. I don't want to give up my money for that period of time. Most annuities, and again, most, because it's hard to paint everything with a brush. When we're talking about fixed index annuities, they have a 10% access per year after year one, usually. So again, if you did need to take income out of it, you could easily access it if there was an emergency after year one. So for her, by the time she got to 70 with her 401k and annuity total, she had about the same amount of assets across the board. But the funny thing is we didn't have to abide by 4% because we eliminated market volatility or losses, and we eliminated fees. So now we're actually able to take up to about 8% income out across the board with the same chunk of assets with no real increase of rate of return, only because we have less losses, less fees, take out way more income. So she ended up increasing her income to essentially about double. Instead of $48,000 a year after tax, it ended up being, I think the exact math was about $80,000 a year after tax by just supplementing your bond portfolio for an annuity with no fee, 9% cap, nothing crazy, where again, she can have almost double the income potentially and not worry about running out of money, because she has a bucket to pull from when the market's down. And that's why we can increase the distribution rate so quickly, is because again, when we have the market that's up and down, we can't take out so much on the good years because we have to save for those down years. So that's where the 4% comes in. When we can take money out of a bucket that doesn't lose money when the market's down, that's why we can increase the distribution to 8% across the board. And again, the cherry on top, which we didn't even touch on yet for her, was she reallocated some of her contributions to life insurance for that 10-year period too. So she ended up having almost double the income. Plus, it was like another $900,000 tax-free at age 90. If she did live to age 90, she still had all this huge bucket of money tax-free to tap into. So that's why I get so excited about this stuff, is it's because you don't really have to do extra money out of pocket. Like, there's no crazy fees. You have access to your money. It gives you a lot of what you're wanting to do already, but you just have to understand that there's pros and cons to everything. Like the pros and cons with annuities quickly, and then we'll go over some questions, is I describe it like this. There's 3 things you have with any financial account, and you can only pick 2 of them. And I would encourage you guys to kind of test this theory as well too. You have growth, protection, or liquidity. You can really only have 2 of the 3 at any given time. So for her, she was 60 years old. So her 401k was fully liquid because of her age. She could take out all the money if she wanted to, obviously pay taxes on it. And it has really good growth potential because it's in the market, but there was really no protection. So she had 2 of the 3. With an annuity, all we're doing is we're saying, hey, growth and protection are more important than full access to our money right now. That's all you're saying. There's no fee. There's no nothing like that. So that's kind of what we looked at for her, is take half of her money, put it in an annuity, protect it, grow it safely and productively. And just simply because of that, plus some of the life insurance on the back end, which she was already putting in her 401k, she just wanted to put it somewhere where it's tax-free. Ended up being almost double the retirement income. No extra money out of pocket, no additional risk, no additional rate of return, just being more efficient with her assets. So that's where annuities come in, is it's not meant to be your whole portfolio, nor is it meant to be none of your portfolio. It's meant to be a certain chunk that makes sense, and it's going to be different for everyone based on their needs, expenses, income, the things that they are looking for. So anything stand out that you want me to touch on?
Oh, a lot. So one, just to kind of reiterate, all you're doing is shuffling your money around that you've already grown and shuffling around the contributions you've already made to maximize your income, to maximize your longevity, because the number one concern in retirement planning is running out of money. More people would rather die than run out of money. And that is a statistical fact. You can look it up. So with everything you just said, like, it to me makes total sense to put some form of insurance in your portfolio. Why would Ken Fisher and Dave Ramsey, if they knew this, if they knew it, I don't know, I don't think they actually know all this. I think maybe they all think that variable annuities are the only annuity, who knows? But if they know that, why would they say that annuities are bad?
So I'll answer that in a traditional fashion of answering a couple different questions too on top of that. With Ken Fisher and Dave, I almost said Ken Ramsey. With Ken Fisher, who's not my dad, by the way, I've been asked that multiple times. With Ken Fisher and Dave Ramsey, they're very good at targeting a specific audience to do what they do. Ken Fisher is a billionaire, not because he sells insurance. He's a billionaire because he rakes in assets under management and charges 1.5-2% fee across the board on all those assets. That's why he makes so much money. So every business model is going to be different. Ken Fisher's is not insurance. He wants to build up a huge book of business that he makes 1-2% on per year for the rest of his life. Because as that money grows, so does the fee, so does the money the advisors make, so does the money he makes. It just is self-fulfilling. So once you build up a huge book, it just never stops. It's way more income than you'll ever make from an insurance book long term. So that's the first thing.
Before you move on from that, if you're listening to this, every $1 million that's in management under the Fisher Investments Group, they make $10,000 per $1 million. Now go look at wherever your firm is, Fidelity, Fisher Investments, whatever, and see how much AUM they have, and then times it by 0.01. That's how much money they make per year on keeping your money in investments.
Yep. So again, that's a long-term asset. They're building up their assets because you are the asset on the balance sheet. Like, same thing. If you have a mortgage, you paying the mortgage, it's an asset for the bank. It's liability for you. It's the same thing with the financial services world. Dave Ramsey, funny enough, I was just talking to Sean about this earlier, and he is really, really good on focusing on how Sean described it, changing someone's financial behavior. He's not focused on sound investment advice. He's like, I want to make sure you are being smart with your money and changing behavior before you even go do anything, which is why I think he bashes so much stuff, is because if someone doesn't have the behavior down of like saving a certain amount per month and credit cards and all that, then I'm actually on the same page. They shouldn't be doing probably a lot of the insurance and stuff, because they should be working on the foundational stuff. So that's what I think Dave Ramsey hates a lot of this stuff, is because his audience is not even ready for that stuff. So it's like the classic, back to the gym space. Hey, I want to do this. I want to do this. Like, bro, you can't even stretch yet. You can't even stretch. I'm not going to go have you train for a bodybuilding show or powerlifting show when you can't even touch your toes or whatever. You know what I mean? So
yeah, and then you ate a Pop-Tart before you came in, and then had a muffin afterwards.
Yeah.
Know.
So that's how that is. And just so you know, when it comes to annuities, a lot of people are like, oh, commission is terrible. Don't do that. That's what Ken Fisher says, is don't ever work with an agent who makes commission. Funny enough, a commission agent actually will make less than a financial advisor, because you look at how long do most people have their account with a financial advisor on average. I mean, you guys could think of that yourself. With an annuity, let's say we did $1 million annuity just for an easy number. On average, someone's going to make 5 to 7% of that $1 million, which is, if most people charge on average a 2% fee across the board, like expense ratios, management fees, about 2% on average. What that is a 5 to 7% is really only 2.5, 3 years of management fee. So a lot of people long term, if they know they're going to be with you, they don't end up doing annuities simply because you give up the right to make money on that income ever again, unless you're doing a lot of variable annuities. Now you can do like an investment advisory annuity where you could have the fee in the portfolio inside the annuity. So there's some cool stuff like that now that exists, but that's few and far between that know that you can do that.
So basically, I can get let's just go on the high end, a 10% commission to sell you this product that's 100 grand. Or I can keep that $1 million in AUM over 20 years and make 2% per year. So that's 40%. So I can make 10% or I can make
Plus
40%. Plus the growth, because so you're building your paycheck higher by growing the money, which is great, but they have an exponential growth curve on their income and on your growth versus protecting, doing everything we just said with the case study.
Mm-hmm. Yep. So again, we're not trying to bash AUM by any means, because we do that as well too, but you have to have a balanced approach. You have to have some money that is risk on, some money that's risk off, which all that means is you need some equities, you need some insurance. And if you do that, you can maximize your retirement income without any additional risk. You don't have to save more. You don't have to make more rate of return. We're just being more efficient with what you're already doing. So that's the summary of it.
Yeah, you said you didn't have to save more, and we didn't touch on that really. So in that case study, you said they had $500,000 in a 401k. First thing I want to touch on is you said the rule of 100 stated you should have put 60% of their money away into the annuity, but you kind of just said, hey, let's do 50%. So you actually took a hit on your commission by not following the rule, which kind of is nice of you. But again, they were contributing money to that 401k, right? Solo 401k, putting in like $32,000 a year,
Yep.
pre-tax. So now the 31,000 that was not matched, it was just literally dollar for dollar lowering their tax obligation.
Mm-hmm.
Going into that 401k was not serving them at all. So taking that 31,000, could have put it in an IRA, could have kept putting it in the 401k, getting that tax deduction. But instead, you basically said after tax, because you can't take pre-tax and put it in post-tax.
Mm-hmm.
After tax, you have about $2,000 a month or 24 grand a year we could put somewhere else. So
Yep.
they're already contributing some money somewhere. We're taking the money they're already contributing, so they're missing out on nothing, and putting it somewhere else. And that created almost $1 million IUL by the time they were at the end of life.
Yeah. And we can touch on that quickly, because a lot of people, I hear this all the time, and it's a misconception if someone doesn't know how to actually plan retirement income. Some people be, oh, I'm 45, I'm 50, I'm 60. I don't have time to do life insurance, which the only time you don't have time to do life insurance is if you're not healthy. That's really the only thing that's a knockout. But in this example, if she was 60, and let's even shorten it, let's say she was retiring at 65, just to give an extreme example, I would never tell someone, hey, let's put your money in life insurance for 5 years and take it out at year 5. Like, that's probably to the point where if we had a good market, it's just breaking even. So you're stopping the whole compound interest curve just to take income. How life insurance a lot of times needs to be a supplement in retirement is, for this lady, we just, like Dustin said, we reallocated what she was putting into her 401k and built her a third bucket of retirement income on the back end, which was life insurance. So we ended up putting $24,000 a year roughly into an IUL. And remember what I said, we were able to increase her income from her 401k and annuity up to about 8% total. So that $1 million a year created about 80 grand of income for up until it was age 90, when she was projected to run out of it. But again, at age 90, we put money into that life insurance policy for 10 years. She stops putting in when she retires. Even at 10 years, it's not going to grow a huge amount, but 70, all the way up until 90 was projected when she was going to need the money. So that's 30 years for that money to sit and grow, tax-free, do its thing, which is great because she drains all of her other accounts, her 401k and annuity, which were pre-tax, spends it all down. And by the time she needs that money, if she passes away and has only that bucket left, all of her inheritance is tax-free. All of her income is tax-free if taxes are projected to double, or, whatever people say they are. So that's where life insurance can fit in for someone who's older, is it's not the bucket you draw from right away. It's the supplement later in retirement when things get more expensive, taxes go up, you're worried about health and long-term care and things like that. It's the supplement on the back end. It's not meant to be something that you take right when you start your retirement income.
Yeah, keeps you from having to go back to work. The tax-free income's at the end. And
Mm-hmm.
again, if you drain the IUL in your 70s or 80s, now you have no death benefit to leave behind. So it's logical in all senses. Keeps you from having to go back to work. If you have long-term care issues, the death benefit's forwarded for long-term care issues. Then if you die later on in life, you leave that pension, or not the pension, but you had the pension that you're leaving behind. And most pensions you can't leave behind unless you have a survivorship. But anyways, that's getting out of hand there. What I did want to touch on, something you said, leaving the money in for 30 years.
Mm.
So the three buckets, if we have like a mental visual, because some people are probably listening to this, you have three buckets. The first one was the FIA. The FIA is completely full because it's maxed out. You're starting to take income out of it. The second bucket was the 401k. It's like half full. And then the third bucket barely had anything in it, just a couple drops.
Mm-hmm.
Well, 10 years later, whenever you drained the FIA, now the 401k bucket's completely full. So we're going to start draining it. Well, at the age of 85, 90, now the 401k bucket's empty, and we're going to go ahead and start on the super full cash value life insurance bucket. And guess what? If you die halfway through all that, you leave the 401k, which is taxable. They have to spend it down your beneficiaries. But then again, you have that massive cash value life insurance bucket that you're leaving behind. Mm-hmm. So it's just a way to, and I said this on one of my reels recently, most people would take, hey, you have a 401k, you have an FIA, and you have an IUL. You can get about $62,000 a year of income post-tax from all three of these buckets. But what they don't tell you, the FIA might run out of money because we might have a downturn here or there. The 401k will probably run out of money. And then now you're just left with your IUL versus just moving the buckets around and only taking from certain buckets, letting the other ones fill up. You know, if you take three buckets down to from the river to the house, it's heavy. You probably spilled some water. Where if you just took one bucket at a time and came back, it's going to last a lot longer. It'd be less tiresome. So again, it's just repositioning assets. I love that.
That's a good point. I think what you were thinking about too there is when you take distributions from something, you stop the compound interest, right? So when we're retirement income planning, the reason we want to have 2, 3, or as many buckets as we can within reason is because we want to drain one bucket. We want to basically spend the worst money first. So in my opinion, for this lady, I think you were right. I think you said we're draining the 401k first in her example. And we could even put that like in the illustration that I'm using. I'm just assuming that we put it in cash in the 401k at age 70. There's no rate of return at all. And we're just draining it. No rate of return, no bonds, no nothing. We just drain it for 7 years or whatever it was, right?
Yep.
Now that's done. Now the FIA has 8 more years to keep growing because we haven't touched it. Then to your point, we tap into that. Now we take 80 grand a year out from that. And it was about 800,000, which gets us another 10 years, which for her, it got her to 89 by the time she even needed the life insurance. But now, again, she let that compound interest curve do its thing, because what does the first 10, 15 years of compound interest look like? It's like this. And then right when you get to the point where you're about to start seeing growth, that's when people start taking income, which is not what you should do. You should let it start doing its exponential curve, then take income down the line. So that's why we like wait until age 90, is because we've had tons of growth. Taxes are at its height. We can take all that money out tax-free. And that's, again, how we optimize the retirement income for someone like that. So that's, again, all I want to mention is make sure that if you are thinking about retirement income planning, if they use the 4% rule, 4% rule doesn't work. The only time it works is if you have stupid money, which, let's be honest, if you had stupid money and you still did the 4% rule, then there's the argument of you're not even being efficient with your wealth. So like, why don't we just help you be more efficient and leave more behind anyways? Just because you have money doesn't mean you should be wasteful of it. So that's the summary, is having multiple buckets in retirement, spend the worst money first, only spend one bucket at a time, leave the best money for last, which is, tax-free, protected, lifetime income, stuff like that. And then if you have real estate, life insurance, and, stocks, all that ends up stepping up at death and is tax-free. So that's why I like leaving that stuff to last if we can, is because all that steps up at death.
Yep. And there's a whole nother episode that we did a couple weeks ago about Roth conversions and how that can be huge with annuities and how that can keep you from having the longevity risk and being able to get that tax-free income. But you can go back and watch that. And then real quick, since we have just a little bit longer, can we pivot towards the agent side and kind of talk to them about why it makes sense? I mean, we kind of did, but just if you were to talk to an agent right now that's just like, oh, there's too much conflicting evidence, annuities only make 3% on average. Like, what would you say to them to change their mind?
I personally am, you are the same way, just because I know you, but I'm very skeptical by nature. I was the agent when I started that was asking all these questions, and they said, you know what, don't ask these questions, be coachable, just do what we tell you. Like, that was not me, because I was dealing with people's money, and I wanted to make sure that we were advising people as best as we could. We don't have a crystal ball, but let's at least make sure we're making informed decisions. So to that point, you're never going to know 100% ever. But what you can do is you can do a lot of investigation on your own. So what I started doing a couple of years ago, when I started having internal conflicts of like, hey, what's true? What does this mean? What's going on? I just started calling all the carriers, and I don't talk to the reps. I don't ever say, hey, what should I do for this client? Because keep in mind, again, the reason we try to coach agents too is because people either learn from their upline, who learn from their upline and their upline and their upline, which they generally don't know anything. Not generally, not all of them. Or they learn from the insurance company, which the insurance company is a for-profit business, and they're going to show you the way that's going to make them the most money and the agent the most money to keep them in business, not the client generally. Again, not all the time, but that's what we've seen from doing this a while. With all that in mind, what I ended up doing is I ended up calling a bunch of different carriers that we worked with and said, hey, can you send me the rate history for all of your products, annuity and life, over the last 20 years? You'd be surprised how many companies are like, no, I can't send you that. No, there were a couple who actually, well, it was more than a couple. It was probably about 8 that we worked with that sent me all the rates, past history rates, current business rates, all that type of stuff. And I just combed through it, and I'm like, cool, what's true, what's not true? Because the insurance companies will make things look as good as they can on paper to try to get business. But we need to make sure we're grounding that in truth of like, hey, what's historically happened? So that's why I only use certain carriers now, is because we want to make sure the rates are held pretty constant through multiple interest rate environments. Because like you said, someone could be getting only 3% rate of return, but that was because they chose the index that the company told them to use, and they didn't know any better because their upline didn't know any better. And this whole thing goes round and round in circles. So I would just say, don't ever take anything for gospel. Do your own research and then validate it. And if all that matches up, then that's what you do for a client. And that's why we do things the certain way that we do it, because I want to be able to sleep at night. And same thing as you, like I've had times when I first started where we did things that I just was like, man, I don't know if that was what we should have been doing. And it just makes me sick to my stomach, So I want to make sure that doesn't happen to anyone's parents or clients down the line either.
I'm glad you put that human element in it and said that we've basically been there before. And we have. I mean, there's been years in a row where we're just like, is this right? And we do some research together, do separate research, come back together. Are these groups right that are telling us that we're wrong, or they're a little bit more right? Do some research, come back together, talk about it. And most of the time, like we said in other videos, there's normally like a left paradigm and a right paradigm, and normally right in the middle is the truth.
Yeah.
And I kind of wanted to touch on David McKnight real quick. He talks about some stuff that when I first started, I was like, man, he's so soft. He doesn't know any better. He's just an old man that doesn't understand new stuff. And then you get a little bit more seasoned and you start to realize, honestly, about 99 times out of 100, I side with what he says.
Mm-hmm.
Now, the one thing that he does say that I don't really care for is he says, like I'd say, David, you have a kid and you're uninsurable and you open up a policy on your child and you fund it just like you would your own. You use it as your own. You pass away, you leave whatever's left over to them. David says not to do that because of the risk for the lapse, the lapse ability and stuff like that. I get it. But if you're taking the right amount of income and you're not just being out of hand with it, and the policy is max funded, it should last, especially if you're using it for yourself as income. And then when you pass away, you just don't turn over the policy, you leave it to a trust or something. Now that compound interest can catch you back up instead of lapsing the policy. And now you're leaving a beneficiary, or you're leaving a lump sum of death benefit to their kids. So your grandkids are getting taken care of, plus you get the income or the reasons why you wanted the IUL. That's the only thing I don't really like. But besides that, I go back to say the old way of thinking and the way the new way of thinking is, like, this is volatility control indexes, 12% rate of return, sell everybody an IUL and tell them to quit funding their 401k. Then you have buy term and invest the difference. And then you have right in the middle is about where we're at, which is like buy term and invest the difference makes sense for A, B, and C. And cash value life insurance will actually fix all of your problems for D, E, and F. So if somebody comes to you and just like, hey, this is what you need to do without asking you a single question, or if they ask you 5 questions and this is something you need to do, probably do need to run. And also another thing too, because we didn't talk about this, not all annuities are made the same. Not all annuity carriers are made the same. There are probably 2 of the top 10 annuity carriers in the United States. I wouldn't touch the 10-foot pole. They're probably going to get in some deep trouble soon. But what that does do is it kind of leaves a cliffhanger of like, well, how do I know? How do I know which carrier to use? I hate to tell you, there really is no way for you to know besides talking to somebody that you can trust. And again, you probably think you can trust everybody, and that's the reason why I get 100 DMs a week saying, hey, can you look at my policy? I had a friend set it up, or a colleague, ex-colleague, and I trust them. Couldn't find out it was wrong. It was the training. So again, you can trust people all you want, but unless they have, I hate to say it, me and Fish are here talking about it and we're giving you all the good, so maybe you should use us because it's kind of a pitch. I'll just say it's a selfless pitch. But again, you really don't know who to trust. You don't know which carriers to trust. You don't understand cap floors, integrity behind the carriers. Like if you don't understand that, you don't know where to go. But again, got to ask yourself, hey, I have a 401k through Fidelity, or, I put all my money with Edward Jones. And if we told you, hey, Edward Jones charges 3%, hey, Fidelity only has like 9 indexes and they're all terrible. You didn't know that before. Now you do. And you think everyone's a scam. It's kind of a big roundabout. And that's the reason why I've personally wanted to get out of this industry for the last year, but there's nowhere that I can help people as much as I do and make even 1/10 of the income while helping people. So I'm still here. Stresses me out every day. I shave my head because I think I'm balding already. But
Me too.
we won't even go there.
Hence the hats.
Yeah. Any kind of closing, I wouldn't say arguments, just any kind of closing statement to get people out of their own head, or just give them a direction to go research a little bit.
Again, this will come off salesy, and I promise I don't mean it to sound like this, but with where the market's at right now, we're at a very interesting point where, again, in my spiel with clients, I kind of run them through, hey, here's what the market looked like for the last 30 years. We had 2000. Remember what happened there? We had the tech boom and the tech bust, right? We had 2007. That was the real estate boom, real estate bust. Then we had this huge run up, and then we had COVID. We had a little bit of a pullback. It was like 40% in March. And then we had interest rates cut, and it just propped the market right back up. But what's interesting is finally the market breathed a little bit in, I think it was last year. Well, 2 years ago now, because we're in 2025. But we just hit another all-time high in December, and the market's starting to pull back. So what I would usually tell clients if they were meeting with me in that situation is, hey, if you are of the age where you have the luxury to protect some money, which is all that means is you either have an old IRA or you are older than 59 and a half and you have current 401ks, IRAs, things like that. Now is a very good time to think about protecting some of the wealth that you've built that you don't want to lose. What I mean by that is if you look at the market from 2000 to 2012, that was a 12-year period. And like we were talking about earlier, generally over a 12-year period, the market does pretty good, generally. But from that period, the market did nothing. It just went sideways for 12 years. So what I ask clients is, hey, can you afford not having any growth on your portfolio for the next 12 years till you retire? Like, no. Well, we probably should at least put some on the side to protect it and grow it safely. Because here's the other cool thing. Some different annuities, depending on what people want, will have a guaranteed income growth rate, not a guaranteed interest rate, but your income will go up a certain percentage every year if you leave it there for 10 years. So you could have 175% more income 10 years from now, even if the market did nothing, which is pretty powerful. So again, that takes, to our whole point, that takes a lot of the stress off retirement. If you say, I know no matter what the market does, 10 years from now, I'm going to have this amount of income, then you could be more aggressive with your other stuff and you're not sweating what the market does. So to summarize, not to sound like a sales pitch, but you probably should consider protecting some of your money with where things are at right now, or at least having someone review it and making sure you're not 90% aggressive. Like this lady, Another lady I met with last week who was just retiring in the end of December. She thought she had a pretty conservative portfolio. It was 85% equities, 15% fixed income.
Yikes.
So when that pullback happens, man, she's going to be feeling it. So that's all I would say is definitely review with your advisor. And if you don't feel that, they're giving you sound advice based on what we're saying, there's no obligation opportunity to just chat and sit with us and see if you kind of like what we do. That's about it.
Yeah, and in my DMs, again, if anyone's following this, they probably know I have a social media that does pretty well. Get a lot of DMs, a lot of comments about financial planning. Most of them nowadays are Primerica agents trying to tell me that I'm a scammer. But basically, I kind of wanted to touch on CDs. So a lot of people forget that CDs are very popular with the older groups of people because back in the 90s, CDs would return 12, 14, 15% because inflation was out of hand. So, of course, if inflation is 15%, the CD's 15%, you really didn't gain anything, but on paper, it looks really nice. So I've had a person the other day had $850,000 in a CD, and they thought about putting it in a 1 year 3% CD just to kind of get by because next point, the S&P's averaged about 30% a year over the last 2 years. How long can that last? Over the last 30 years, the S&P's averaged 9%. So do you think that we can have another 30% year, 2 more 30% years in a row? That's pretty insane. If it does happen, great. I hope so. I hope that the leadership in the White House and the free world actually makes that happen, but will it happen? We don't have a crystal ball, but statistics show it's probably not going to happen. So if you have friends, family, grandma, grandpa, someone you work with that they love CDs, guess what? CDs are actually a lower rate of return than annuities because CDs normally go off of what the inflation rate is. They'll give you maybe a half a point above inflation versus, like you said, with an FIA, we can have a 0% floor and like a 9% cap. So if the S&P, hits a cap for the next 2 years, we would get 18% total. If 3 years it tanked, we would just get the 18% plus 3 zeros. So you lock in your gains versus having like a 4.25% CD over 5 years. So say all that to say 30% average can't really last forever. I hope it does. Wish it would. But again, you got to quit listening to all the gurus, all the Dave Ramseys, all the Ken Fishers about annuities and certain financial products. And last thing I'll say, I had a person who's a social media marketer in my industry. I respect her to death. She's in the Hispanic community. She had a post that in 2 hours had like 4,000 comments and 1 million views. And about half of those comments were Primerica agents. And I keep bringing up this company. Hopefully I don't get in trouble one day, but Primerica, I guess one day just said, hey, social media exists. Let's go out there and talk to everybody. So they are basically the new social media trolls. They are the bot farms where they go out and just say, hey, if anybody is not talking about buy term and invest the difference, go on, leave a nasty comment and report them. So again, I say all this to say, like, the tides are shifting, and I don't know how long social media marketing can last, and I don't know how long we can last in an industry like this, but you got to pick your advisor correctly and stop listening to the gurus.